Hello, hi guys, how are you? Hope you people are doing well. Even I am fantastic. In the yesterday's class, we have started with a bank audit and we have discussed some of the topics. Still, we are left with a lot of topics in bank audit. Now, we'll be starting with those remaining topics. Yesterday, we have stopped at this bills for collection and bills for purchase. First of all, what is this concept of bills? Let's say there is a particular seller. He sells goods on a credit basis and the credit period is, let's say, some 10 to 15 days. Now for this 10 to 15 days, the amount of the seller gets blocked. So what the seller he will do is he will take a receipt or he will take a bill of purchase from the buyer. On that bill, the signature of buyer will be there and it will be stated that amount will be paid by the buyer within 10 or 15 days. Like this, a bill will be taken by the seller from the purchaser. Now, in order to collect these bills, seller he will be having various customers. For various customers, he would have sold goods on credit basis. His business is to sell the goods or to do his major business, but his business is not to collect the amount from customers. He cannot concentrate on collecting amount from the customers. So what he will do is he will outsource this transaction of collecting amount from the customers against these bills. So what he will do is he will delegate this function to the bank. He will go to the bank and he will give these bills which he has collected to the bank, and he will authorize the bank to receive amount from the customers. So now on behalf of seller, bank will receive amount from the customers. For doing this transaction, bank will charge certain commission. These are bills for collection. Generally, bank will help the sellers to collect their bills. This is the concept of bills for collection. Now in regard to this bills for collection, what are the internal controls that has to be established? Let us see. Firstly, all the documents accompanying the bills should be received and entered in the register by a responsible officer. Whenever a bank gets any bills for collection from its customers, those bills has to be properly noted down in the register along with the details, like when this bill has to be collected, from whom this bill has to be collected, how much is the amount of the bill, and what are the supporting documents. All this has to be properly entered in the register that is being maintained by the bank. That is the first internal control. Next, accounts of the customers or principal should be credited only after amount has been collected. Now, the customer, you can call the seller, has given bill to the bank, asking the bank to collect the bill on behalf of that seller. Now, bank has to collect the amount from the debtor and deposit that amount into the account of the seller. Now the bank has to deposit the amount only after it has collected the amount from the debtor. It should not credit the account of the seller without collecting amount from the debtor. This is also another internal control that has to be implemented. Next, it should be ensured that bills sent for one branch for collection to another branch of the bank are not taken into the bills for collection twice in the amalgamated balance sheet. That means, let's say there is Kurnool branch, okay, Kurnool branch of SBI, and there is a Chennai branch of SBI. Now let's say a particular seller in Kurnool has sold goods on credit basis to a buyer in Chennai. Buyer is in Chennai, seller is in Kurnool. Now the buyer, he has given bill to the seller. Seller gives this bill to the Kurnool branch of SBI asking to collect the amount from the customer who is in Chennai. Now what this SBI branch of Kurnool will do, it will transfer this bill to Chennai branch, so that Chennai branch will collect the amount from the customer. Now in this case, if you see, first of all, bill has been received from the seller in Kurnool to Kurnool branch of SBI. Here what the SBI branch will do, it will record in its books as bills received. Okay, bills for collection received from the customer, like this they will write the entry. Now the same bill is transferred to Chennai branch. Now what the Chennai branch will make entry, it will also make the entry bills for collection received from so and so Kurnool branch. Now this is okay if you see individual financials, but at the bank level, if you consolidate the financials of all branches, there will be duplicate entries regarding the same bill. So one entry has to be written off in case of amalgamated financials. Okay, that is another internal control that has to be established, so that no duplicate entries will be passed regarding the bills for collection sent to another branch for collection. Those are internal controls with respect to bills for collection. Coming to bills for purchase, what is this bills for purchase? In case of bills for collection, the seller has given the bill to the bank asking to collect the amount on behalf of seller. The bank will credit the account of seller only when amount is collected against that bill. That is bill for collection. In case of bills for purchase, the seller is in urgent need of money. He urgently wanted money, and he is having bills receivable of some 100 crores, and he is in urgent need of money. So what he will do is, he will directly sell this bill to the bank. This time he is not providing this bill to the bank for the purpose of collection. No, he is selling the bill straight away to the bank. Let's say the amount of bill is 100 crore. Now he will sell the bill for some 99.5 crore rupees, like that. 99.5 crore. Balance, that 0.5 crore, 50 lakhs is there. Na? That will be profit to the bank, because on the due date, bank will collect this entire 100 crores from the debtor. Bank will collect entire 100 crores from the debtor, and as on present date, while purchasing the bill, bank will pay 99.5 crores straight away to the seller for purchasing this bill of 100 crores. So this way bank has made a profit of 50 lakhs. This is the concept of bills for purchase. Now in case of bill purchase, what should be the internal controls? At the time of purchase of bills, officer should verify that all the documents of title are properly assigned to the bank. If in case the debtor has offered any security against that bill, that security would have been kept in the name of seller. Now bank is purchasing the bill from the seller, so underlying security should also be transferred into the name of the bank. That has to be taken care. Next, sufficient margin should be kept while purchasing a bill to cover any decline in the value of security. Now here he can consider this as margin. The bill value is 100 crores, but he is purchasing for 99.5 crores. Here margin is 50 lakhs. So what should be the amount of margin that has to be kept by the bank has to be carefully determined by the bank based on value of security and what is the risk of the value of security falling down. Based on all these factors, the bank has to determine proper margin to cover itself. Next, if the bank is unable to collect a bill on due date, immediate steps has to be taken to recover the amount. Steps has to be taken to realize the security that has been issued. If bank is not able to collect the bill amount on due date, if debtor is not paying the amount, then bank should start immediate steps to recover that amount. And all irregular outstanding accounts should be reported to the head office. Okay, if at all there are any irregular outstanding accounts, those accounts has to be immediately reported to the head office without any delay. Generally, these bills for purchase transactions, they will be taken they will be entered by branches. So at the branch level, if there are any pending outstandings regarding these bills purchased, the intimation regarding the same has to be given to head office. And in case of bills purchased outstanding at close of the year, discount received thereon should be properly adjusted. Let's say bank has purchased the bill on 26th March of 2023 and the due date of bill is, let's say, some 18th April 2023. Now here the bill on this bank will be earning certain commission, right? This commission income has to be properly bifurcated between these two financial years. Based on the period covered, the bifurcation of this commission has to be done properly between financial year 22-23 and financial year 23-24. Regarding this, internal controls has to be placed. Basically, the bank's core banking software, core banking system itself will be having internal controls. It will automatically calculate income and it will bifurcate the income between two financial years. Auditor has to check whether such system is available or not, whether such procedure of automatic calculation of commission and such a procedure of automatic bifurcation of commission is present in the core banking system or not. That has to be verified by the auditor, whether that internal control is there or not. Next, coming to loans and advances. This loans and advances, internal controls related to loans and advances, general topic. First of all, while granting the loan, you should take care that the CIBIL score of the borrower is proper, all the documentations are entered properly. Okay, see, bank should make advances only after satisfying itself as to credit worthiness. Credit worthiness means you have to check the CIBIL score of the borrower and after obtaining sanction from the proper authorized officer of the bank. In order to grant loan, sufficient authorizations from the higher officers has to be taken. Only based on authorizations you can grant the loan, and all the necessary documents should be executed. Bank might take up insurance with regard to that loan, and bank will also take documents related to security. If any land has been offered as security, let's say, then documents related to that land will be kept with the bank, and bank will also take the KYC documents of the customer, and it will also take cancelled checks. Generally these days they are not taking, most of the banks they don't take cancelled check, but instead they are facilitating this NACHI. NACHI means automatic debit facility. Okay, on the due date the amount, the EMI will be automatically debited from your account. This NACHI facility will be activated on your account if you have taken the loan. Regarding that, certain declaration will be collected from the customer. So all these documentations has to be properly entered at the time of granting loans. Next, sufficient margin should be kept against the securities. Let's say you are giving a loan of some 1 crore rupees. In that case, you should keep sufficient margin for the security. That means you should accept at least 1.3 crore value of security. Okay, if borrower is giving land as security, then you have to make sure that the value of land is at least 1.3 crore. There should be sufficient margin available between the amount of loan granted and the value of security. This depends based on the policy of the bank. Okay, what should be the minimum margin will depend based on policy of the bank and the credit worthiness of the borrower and amount of loan. Based on all these aspects, this margin will be decided by the bank. And all the securities should be received and returned by responsible officer. At the time of accepting the securities and at the time of giving back the securities, they have to be taken care by a responsible officer. And all securities requiring registration should be registered in the name of bank. If you have accepted land or any building as security, then registered mortgage will have to be done. This registered mortgage has to be done into the name of the bank. Okay, so if there is any necessity to register the security into the name of the bank, proper registration has to be done. And all accounts should be kept within both drawing power and sanctioned limit as per the prescribed norms. Basically, this will be applicable in case of CC and OD. Generally, what will happen is, let's say a customer wanted a cash credit or overdraft cash credit, let's say. Now, bank has given cash credit of some 1 crore rupees. Bank has given cash credit of 1 crore rupees. This is sanctioned limit. 1 crore is a sanctioned limit. Now, borrower, what he has to do is, for every 3 months he has to submit stock statements to the bank. In the stock statement, it will be mentioned what is the value of the stock as on a particular date. This stock statement has to be submitted on a quarterly basis. Now, based on value of the stock, drawing power will be determined. Drawing power. Sanction limit is 1 crore. If borrower wanted to withdraw entire 1 crore, then the value of the stock should also be 1 crore. Okay, basically this value of the, for calculation of value of stock, there is a particular procedure. You will have to take sufficient margin. Let's say physically the entire stock that is present in the godown of the borrower is 2 crore rupees. This is the physical stock that is present as on date. Now, from this 2 crore rupees, stock of value 50 lakhs has been purchased on a credit basis. If the borrower himself has purchased stock on a credit basis, then there is no blockage of money for the borrower with respect to that stock which has been purchased on a credit basis. So, since there is no blockage of fund for the borrower, that 0.5 crore will be reduced from the stock, because here we are calculating drawing power for cash credit. what is the purpose of cash credit? The purpose of cash credit is borrower has blocked certain amount in the form of debtors and certain amount has been blocked in the form of stock. To cover up that, he is taking cash credit. Now here stock of value 0.5 crore is purchased on credit basis. That means he has not yet paid the amount to the supplier. In that case, there is no blockage of fund to the borrower with respect to stock of value 0.5 crore. So 0.5 crore worth of stock will not be considered for calculating drawing power. That will be reduced. Now we have 1.5 crore. And generally, in case of stock, banks, they will keep margin of 25%. In case of stock, it is 25%, and in case of debtors, it is 40%. So from this 1.5 crore, 25% will be reduced. 25% means it comes to be 32. So let's say round figure 0.3 crore. So the value of stock that is available is 1.2 crore. Now this figure 1.2 crore will be stated in the stock statement. Since stock value is 1.2 crore and the sanctioned limit is 1 crore, the drawing power to the borrower will be 1 crore. Because sufficient stock is available. Stock and even debtors will also be included in the stock statement or debtor statement. Now let's say if the value of stock that is available with the borrower is not 1.2 crore, it is just 60 lakhs only. 60 lakhs only. In that case, drawing power of the borrower is 60 lakhs for that quarter. He cannot withdraw more than 60 lakhs from his cash credit account. Even though his sanctioned limit is 1 crore, his drawing power will be only 60 lakhs. If for the next quarter, if the stock has been increased, then drawing power will also be increased. Hope that is clear. Most of the students, they don't know this concept, so I have taken some time to explain that. So now the internal control that has to be established is always the account should be kept within drawing power and also within sanctioned limit, and there is a certain lenience wherein additional temporary limit may be sanctioned for a maximum of 20% of the existing limit and 90 days maximum tenure. Let's say if borrower urgently in need of money, in that case on a ad hoc basis some extra amount can be given to the borrower. That extra amount cannot be more than 20% of the existing limit. If existing limit is 1 crore, additional 20 lakhs can be given to the borrower in excess of 1 crore. That too for a maximum period of 90 days. Okay, this is some lenience that has been given if borrower is in urgent need of money. Hope that is clear. This you have to remember. It might be asked in MCQ. Next, all accounts which exceed the sanction limit or drawing power or against unapproved securities or otherwise irregular should be brought to the notice of management or head office. All the irregular advance accounts has to be brought to the notice of management or the head office, and the operation in each account has to be reviewed at least once in a year. The branch manager or appropriate officer, he has to review the transactions in the account at least once in every year. Okay, those are general internal controls that has to be placed in case of loans and advances. Next, credit card operations. With regard to credit card, what are the internal controls? Same points. First of all, proper screening of the application has to be done. Okay, proper credit worthiness has to be checked. Here the key term is screening of applications has to be done properly. Then there should be strict control over the storage and issue of cards. Okay, the credit cards, the physical credit cards, they should be kept in the custody of proper officer, and there should be proper controls with regard to issuance of the cards. And there should be a system whereby merchant confirms the status of unutilized limit of credit card holder before accepting the amount. Generally, merchant, he will be having, let's say, some POS system, or there is a online website. In this website you are purchasing using your credit card, you have given your details, and while accepting this transaction, merchant, what he has to do is he has to communicate with the bank whether this particular customer is having the limit or not, whether the limit has been exceeded. The merchant has to accept the transaction only if limit is available with the credit card holder. If limit is not available, merchant should not accept the card. All this, it will take place automatically. Okay, in the system, in the basically banks, they will be having a particular payment system. In that, all this will be automatically implemented. Before accepting a transaction, the server, the system will automatically inquire the available limit with the bank servers, and it will communicate to the borrower. Those POS systems, they will accept the amount, they will approve the transaction only if the limit is available to the borrower. Okay, available in the credit card. So that is also one of the internal control. Next, there should be system of prompt reporting by merchant of all settlements accepted. Generally, on a daily basis, the merchant will be reporting to the bank regarding all the settlements that he have accepted in that particular day. If you see on our website, on our Lecturepedia website, basically we are using Paytm payment gateway. Now all the payments that we have accepted today will be settled to our account tomorrow. So all these payments which we have accepted today has to be communicated to them. Based on that, they will release the payment in the next day. But however, now in this information technology era, there is no need of communication. They will be making a track of all the transactions that have been accepted by the merchant. So automatically by next day, the amount will be transferred to the account of the merchant. Next, reimbursement to merchants should be made only after verification of validity of merchant's acceptance of card. The bank, once the merchant communicates to the bank stating that I have accepted all these payments today, like this he will communicate. Now bank has to release the payment to the merchant only after verifying whether merchant has actually accepted that credit card transaction or not. The payment has to be released only if the merchant has validly accepted that credit card transaction. Even that is another internal control. And all the reimbursements should be immediately charged to the customer's account. Gross of commission. See, once the customer, the credit card holder, swipes his card at any POS machine, if limit is available, his account will be charged for the transaction amount. So that account of the customer has to be charged immediately. Okay, on a real time basis, the account of the customer has to be debited for the amount of transaction, including the charges. If at all there are any charges that has to be collected by the bank, even those charges has to be debited to the customer's account. This should happen on a real time basis. and there should be a system to ensure that statements are sent regularly to the customers. Generally, for the credit card holder, at the end of the month, the credit card statement will be sent to the email. If he wants physically, it will be sent physically. Okay, the statements regarding credit card has to be properly sent to the customers. These days all are automatic. At the end of the month, the statements will be automatically mailed by the systems to your email address. Just a second. Yeah. And payments overdue beyond reasonable period should be identified and attended carefully. If in case the customer is not paying the amount, the credit card due, there will be recovery agents. They have to take care, they have to properly follow up the customer and collect the amount. So these are the internal controls with regard to credit card operations. Next, compliance with CRR SLR. What are this CRR SLR? Cash reserve ratio and statutory liquidity ratio. Basically, with the help of these ratios, RBI will control the interest rates. It will also control the credit facility available in the market. Basically, what happens is banks they will collect deposits from the deposit holders, from the customers. They will accept deposits. Now these deposits will be utilized to give loans. With these deposits they will give loans. Now just imagine a situation. Bank has accepted 100 crore deposits and bank has given 100 crore loan. That means entire amount that has been accepted as deposits has been given as loans. In this case, suddenly if any customer comes to bank and asks the bank to give the amount, the customer wanted to withdraw amount. Let's say he wanted to withdraw some 3 crore rupees. Now bank is not having liquidity. It has accepted 100 crores and it has given 100 crores as loan. Now if customer comes and asks the bank to withdraw the amount, how the bank will give the amount? So to take care of this situation, to maintain liquidity in the bank, what RBI has done is, RBI has come up with 2 ratios. One is cash reserve ratio, another one is statutory liquidity ratio. Now what is cash reserve ratio? Basically, as of now, cash reserve ratio is 4.5%. Now what the banks they have to do is, of the total demand and time liabilities that they have accepted, 4.5% has to be deposited with RBI. That means in this case our bank has accepted 100 crores. Of this 100 crores, 4.5%, that means 4.5 crore has to be deposited with RBI. Okay, now the bank is having 95.5 crores to give as loans. Still not completed. There is another ratio, SLR ratio. Bank cannot give all that 95.5 crore as loans. Still there is SLR ratio. Basically, as of now, SLR is 18%. So of total demand and time liabilities that the bank has accepted, 18% has to be kept with the bank in the form of liquid assets. of total 100 crores deposits it has accepted, 18%, that means 18 crores has to be kept in the bank itself in the form of liquid assets. Liquid assets means cash, gold, or any readily realizable bonds. All these will be coming under liquid assets. So of 100 crores, 18 crores should be kept in the form of liquid assets. That means 4.5% gone as CRR, 18% gone as SLR, and balance remaining amount it can give as loans. So in our example, 95 crores minus 18 crores, it will turn to be 85 crores, 80 crores, let's say on around average 75 crores. So this 75 crores can be given by bank as loans. Now bank will be having sufficient liquidity in case if any depositor comes to the bank and asks for a withdrawal of their amount, bank will be having sufficient liquidity and it can easily give the amount back. So this is the use of CRR and SLR, cash reserve ratio and statutory liquidity ratio. This is one of the use. There are many other uses of this CRR and SLR ratios. With the help of these ratios, bank will also control interest rate in the country. To control interest rate, bank will also the RBI will also use repo rate and reverse repo rate, and RBI can also use CRR and SLR to control interest rate. It will also control inflation rate in the country with the help of this CRR and SLR. So these are the use of CRR and SLR ratio. Now you can get a doubt, sir. You are saying you have to calculate 4.5% as CRR, 18% as SLR. On which this percentages has to be calculated? On demand and time liabilities, these percentages has to be calculated. What are these demand and time liabilities? Demand liabilities means your saving accounts. Saving accounts balances will be coming under demand liabilities. Term liabilities means fixed deposits, recurring deposits, they will be coming under term liabilities. So on those demand and time liability balance, CRR and SLR has to be calculated. Okay, when it has to be calculated? See how many doubts you are getting. When it has to be calculated, basically what RBI says is this CRR and SLR ratios has to be maintained based on demand and time liability position as on last Friday of second preceding fortnight. Last Friday of second preceding fortnight. As on this date, what is the amount of demand and time liabilities that has to be calculated? On demand and time liabilities, CRR and SLR will be calculated. Okay, now you have to understand what is this, what is meaning of this last Friday of second preceding fortnight. Let's say you wanted to decide CRR and SLR for March 22. Okay, March 22, 2023. On this date, you are verifying whether bank is properly maintaining CRR and SLR or not. Auditor is verifying whether as on March 22, 2023, bank is properly maintaining CRR or not. Now, how the auditor will proceed is, first of all, this date is there na, March 22, 2023. It will be falling in which fortnight? Fortnight means a period of 15 days will be considered as fortnight. Now here if you see this March 2023 date will fall in the 16th March 2023 to 31st March 2023. This is the current fortnight. If I have calculated one day less or more, you just round it off. Okay, I am just giving example, so I might not take exact days. Okay, but you remember that fortnight means 15 days. Now this is the current fortnight. What he is saying, last Friday of second preceding fortnight. For the current fortnight, preceding fortnight would be on an average 1st March 2023 to 15th March 2023. This is the preceding fortnight. Now he is saying second preceding fortnight. Second preceding fortnight would be from, let's say, 13th February 2023 to 28th, let's say, for example. In 2023, I guess we got 27th February 2023. This is the second preceding fortnight. See, for the current fortnight, second preceding fortnight is 13th February 2023 to 27th February 2023. That means second preceding fortnight will keep on changing based on which date you wanted to determine CRR and SLR. Okay, now in this second preceding fortnight, last Friday, let's say in this fortnight 2 Fridays are coming. Let's say, for example, first Friday is, let's say, is coming in some 18th, and second Friday, that is last Friday, is, sorry, let's say first Friday is coming on 20, and last Friday is coming on some 26th. So last Friday of second preceding fortnight, on this date, what are demand and time liabilities? How much demand and time liability is there? Let's say 100 crore. Now on this date there are 100 crores demand and time liabilities. Now, so now for this fortnight, bank has to maintain CRR and SLR on that 100 crores. Hope this is clear. This is how they will calculate CRR and SLR. Basically all this concept, it is not explained in your book, but if you wanted to understand what is the CRR and SLR, you need to know all this. Okay, only then you will be feeling comfortable with the subject. Now, so with regard to CRR and SLR, how the auditor will verify? Here they have given what is the definition of CRR. Is a specified minimum fraction of total deposits of customer which a commercial bank has to hold as reserve in cash or deposits with a central bank. You just remember that CRR has to be maintained with RBI. SLR has to be maintained within the bank itself. CRR must be in the form of cash or deposits. Must be in the form of cash, you can say, and SLR can be in the form of liquid assets. Liquid assets are gold, cash, or any balances with other banks, or any other deposits which are realizable immediately. So all this will be coming under liquid assets. Statutory liquidity ratio must be maintained in the form of liquid assets, and it should be kept within the bank itself. It need not be deposited with the RBI. And CRR as of now is 4.5%, SLR as of now is 18%. Audit procedure regarding CRR and SLR. First of all, what the auditor will do, obtain understanding of relevant circular instructions that have been given by RBI. Basically, RBI on a regular basis, it will be giving various circulars regarding how this CRR and SLR has to be calculated. For calculating CRR and SLR, the main item is demand and time liabilities. So what should be included in demand and time liabilities, what should be excluded in demand and time liabilities, regarding this RBI will be giving guidance. So all those circulars has to be properly understood by the auditor. Next, request the branch auditors to send their weekly trial balance as on Friday, and these are consolidated at the head office. Basically, what the central statutory auditor he will do is, he will ask the branch auditors to send trial balances as on any day, as on Friday, not the auditor. Basically, banks, what they will do is, this CRR SLR is there na, that has to be maintained bank wise, not branch wise. Bank will be having many branches. We have to see this CRR SLR not branch wise. At the bank level, you have to see CRR and SLR. Now, to calculate at the bank level, bank will be requiring data. So for that, what they will do is, they will ask the banks, they will ask the branches to give their trial balances as on Friday, because on last Friday of second preceding fortnight, on that day you will calculate the demand and time liabilities now. So on that date, their trial balance has to be taken, and from their trial balance, all the demand and time liabilities has to be consolidated, and from that consolidated demand and time liabilities, you will calculate CRR SLR. Okay, here you will take help of branches. That is the second point. Now, if auditor wants to verify, the statutory central auditor wants to verify, he should also take the trial balances from the branch auditors. So he will request the branch auditors to give the trial balances on some selected Fridays. Okay, the central bank auditor, he will select some reporting Fridays, and he will ask the branch auditors to give the trial balances as on those selected dates. Okay, on sample basis, he will select some dates to check whether bank is complying with CRR and SLR requirements or not. So see, examine on test basis consolidation regarding DTL position prepared by the bank with respect to related returns received. Now, bank would have calculated demand and time liabilities. Now, auditor has to check whether that demand and time liabilities has been calculated properly or not, because the entire ratio depends on demand and time liabilities only. Now, if you see, what has to be excluded from demand and time liabilities, what has to be included in demand and time liabilities, this is important. In exclusions, there are 5 points, and in inclusions, there are 2 points. This third point, this is also related to second point only. So there are 5 items that has to be excluded while calculating demand and time liabilities, and there are 2 items that has to be included in calculating demand and time liabilities. Let us see. Firstly, paid up capital, reserve, any credit balance in profit and loss account of bank, amount of loan taken from RBI, and amount of refinance taken from Exim Bank, NHB, SIDBI and NABARD. If bank has taken any loan from RBI, NABARD, all those has to be excluded while calculating demand and time liabilities, because those do not represent the amount that has been taken from the public. They have been taken from various banks, and even paid up capital should also be not included in demand and time liabilities. Next, part amounts of recoveries from the borrowers in respect of debts considered bad and doubtful of recovery. Okay, in case the bank has recovered any part amounts of the debts which have been considered as doubtful, then even those doubtful debts should not be included in demand and time liabilities. Next, amount received in Indian currency against import bills and held in sundry deposits depending, just a second, sundry deposits, held in sundry deposits pending receipts of final rates. Basically what happens is, there is a Indian importer, he imported goods from USA. So what he will do, he has to pay the amount to the USA person in dollars. He will give amount in Indian rupees to the bank, Indian bank. Now the Indian bank, it will convert the amount into foreign currency using foreign rates, and it will pay to the foreign customer. Now in between there will be certain buffer time, okay, to take place the transaction. Some 1 or 2 days will take place, okay, 1 or 2 days delay will take place. Now during this time the amount is given by Indian importer in the form of rupees, but bank is still waiting for the receipt of exchange rates. Only after receiving exchange rates this amount can be converted into foreign currency and can be paid to the foreign customer, foreign seller. Now for this period this amount will be available with the bank only, but these will not be coming under demand and time liabilities, okay. This is not the demand and time liability of the bank, because it has not taken this amount from any deposit holder as a liability. It has taken the amount to facilitate the transaction. So on this amount it need not maintain CRR and SLR. So this amount will not be included in demand and time liabilities. Hope that is clear, because it will be cleared in 1 to 2 days. The amount will be given by the bank, the transaction will be cleared. So just for maintaining that amount for 1 to 2 days, if you ask the bank to comply with the CRR and SLR requirement also, it is not a good idea to ask the bank to maintain CRR and SLR even on that balance also. So this balance is excluded from demand and time liabilities. Next, unadjusted deposits balances lying in link branches for agency business like dividend variance, interest variance, refund of application money, etc. in respect of shares. Basically whenever a company is giving any dividend, the bank will specify a particular link branch. The dividends will be routed through that link branch only. So the company has paid the dividend amount to the link branch, and still the link branch has not disbursed that amount to the shareholders. It needs some time to process the payments. So for this small gap of 1 day or 2 day, amount will be held with bank only. Now on this amount that is being held by bank as part of agency business, okay, here the bank is helping the company to distribute dividends. So bank is acting as a agent. So as a part of agency business, the amount is available with the bank for just 1 or 2 days till the transaction is processed. So even this amount which is available with the bank as part of agency business should also not be included in demand and time liabilities, okay. And finally, margins held and kept in sundry deposits for funded facilities. Funded facilities means loans that has been given. Let's say bank has given a loan of some 1 crore rupees. Now for giving loan of 1 crore rupees, let's say it is a working capital loan. Now for giving loan of 1 crore rupees, bank will accept some security. Let's say borrower has given security of land. Value of land is 80 lakhs and the loan that has been given is 1 crore. Still some 20 lakhs security has to be given. let's say along with the margin some 30 lakhs additional security is required. For that 30 lakhs the borrower is not having any asset. In that case what he can do is he can give the cash, or if he has made any deposits with others, those deposits can be offered as securities. Now this amount of cash which has been accepted as security or any deposits accepted as security should not be included in demand and time liabilities, because this amount has been accepted not as liability. Bank has accepted this amount to cover the security for the loan that has been given by the bank. Hope that is clear. So these 5 items should be excluded from demand and time liabilities. Next, inclusions in demand and time liabilities. What should be included in demand and time liabilities? Net credit balance in branch adjustment accounts. Basically branch adjustment accounts is between the branches some transactions will take place. Now basically if a transaction taken place between the branches, those transactions will also be recorded. Okay, one bank will debit the transaction, one bank will credit the transaction. If debit and credit is passed, there should be no amount left in the branch adjustment account. But due to, let's say, some errors or due to some unprocessed transactions, the branch adjustment account is showing some credit balance. This has to be reconciled and adjusted by the bank, and the difference has to be made 0. Now if you see literally, this net credit balance in branch adjustment account will in future will become 0. There will be no difference, it will become 0. So this balance should not be included in demand and time liabilities. But if you see, RBI says that you have to include this net credit balance of branch adjustment accounts in calculating demand and time liabilities. Basically before 2015 this item is there na, net credit balance in branch adjustment accounts. It was not included in demand and time liabilities, but in 2015 RBI has brought a circular, and in that circular it has stated that banks must include this net credit balance in branch adjustment accounts for purpose of calculating demand and time liabilities. The reason for making that change is banks, they were earlier not adjusting these branch accounts properly. Okay, if any amount is showing in the branch adjustments accounts, they were taking it lightly, they were not taking it seriously. They have to be those accounts has to be reconciled and balance has to be brought to 0, but the banks were not paying any, branches were not paying any attention to that. So what RBI has done is, now if there is any balance showing in branch adjustment accounts, on that CRR and SLR should also be maintained. That means banks now what they will do, they will as early as possible they will try to reconcile the branch adjustment accounts and they will bring the balance to 0, so that their funds will not be blocked in CRR and SLR ratio. Okay, this is the intention of RBI behind including this net credit balance in demand and time liability calculation. Okay, if you include the amount in demand and time liability calculation, the CRR and SLR will be increased. Okay, if CRR and SLR is increased, the amount that is blocked by the bank will also increase. Why any bank wants to block its amount? Okay, it wanted to give as much as amount as possible in the form of loans. Only then it can earn money. So it will immediately reconcile the branch accounts, adjustment accounts, and it will bring the balance to 0. Hope that is clear. Next, borrowings from abroad by banks in India needs to be considered as liabilities to others, and thus needs to be considered at a gross level, unlike liabilities towards banking system in India which are permitted to be netted off. Basically, if Indian bank has borrowed any amount from the foreign banks, then even that has to be included in demand and time liabilities. Generally, if Indian banks borrows amount from Indian bank, then what RBI allows is, let's say there is SBI, there is HDFC. Now SBI has taken a loan of 100 crores from HDFC. In the same way, SBI has given a loan of 50 crore to ICICI. Now in this case, since both the banks are Indian banks only, in the demand and time liabilities of SBI, what it can do is, it can set off this 50 crores against the 100 crores and include only 50 crores as demand and time liability position. But in case of amount has been borrowed from foreign branches, foreign banks, then this netting off is not allowed. You have to include entire amount in the demand and time liability position. Hope that is clear. And there is this concept of nostro accounts. Basically, see, the reconciliation of nostro accounts needs to be scrutinized carefully to analyze and ascertain if any inward remittances are received on behalf of customers, constituents of a bank, and have remained unaccounted, or any other debit inward entries have remained unaccounted and are pertaining to any liabilities for the bank. See, what they are saying is, first of all, what is this nostro account and what is this mirror account? Let's say there is SBI bank. Now, let's say in America there is a Silicon Valley Bank, SVB. This is an American bank. Now the account that SBI will maintain with the foreign bank is known as nostro account. In the same way, foreign bank maintains account with the SBI is known as mirror account. Okay, why it is called mirror account? Because all the transactions that are reflected in nostro account will be reflected in reverse manner in this mirror account also. So it is called mirror account. This is nostro account and mirror account. Now bank has to ensure that these two accounts are properly reconciled. Okay, there should be proper reconciliation between these two accounts. That is regarding a requirement of cash reserve ratio, statutory liquidity ratio. I guess I have taken a lot of time to explain this concept. No worries, sir. It is worth taking that much time to explain that concept, otherwise you will not understand. Still we have some basic questions. We will see them in the next class. Okay, I am winding up this class as of now. Take care, bye bye, see you.